Okay, good afternoon, guys. Again, sorry for the delayed market briefing. So what I'll do is I'll keep it fairly short today, and actually there's not too much to talk about either, so that will work pretty well. I mean, really, this week, although it's the end of the summer, I think largely speaking, the data calendar has been very light and continues to be so, and I think largely speaking next week will probably be where the volume comes back to the market. The post-summer lull comes to an end. Just been looking at next week's economic calendar, and it's pretty busy. We've got some punchy numbers in there. Tuesday we've got retail sales and business inventories. Wednesday industrial production, Empire manufacturing. Thursday we've got jobless claims and Philly Fed manufacturing, and then Friday we've got consumer confidence. So it's quite a big week next week, and I think largely speaking people are just holding off until that fundamental news flow gets going. Take a look at my charts then. We've got the S&P at the top. Bear in mind that we're using the 0910 chart just because of rollover issues. We've got oil bottom left, euro dollar bottom right, and really just taking a look at the S&P, having had a fantastic week last week where we rallied back above 1100. Really the main story so far this week has been the debt crisis in Europe being brought back into focus with the rumours about a certain bank requiring 60 billion euros and the fact that they may well be carrying more euro toxic bonds than had previously been discovered during the stress tests. Okay, so that caused the downside that you can see here in equities. That caused the downside that you can see here in the euro dollar. And really what's happened since then, so what happened yesterday, certainly for equities, as you can see, we've retraced a good portion of that, almost all of it, and we're pretty much back to where we were at the end of last week, or sorry, the start of this week, end of last week. So that concern about the European debt crisis just has diminished. We had a good couple of auctions out of Europe, which went a long way to cooling those fears. We had a good Portuguese and Polish bond auction yesterday, so that just lowered any concern. We also had good comments out of ECB's Mersch saying that effectively the European recovery is on track and that they're going to begin to look at removing stimulus. So he was quite optimistic, and I think those two factors have just taken the European debt crisis back out of the spotlight. So equities have rallied off that, and we're back up above 1100, as you can see. Our first target today, 1107. That's the high from Monday. So we'd be looking to get long at 1097. That was the good support level overnight, you can see during the Asian session, and also basically that's where we started from at the European Open at 8 AM. We've just had a lift since then, and we're just, it's very quiet though, and I would say largely speaking we may well stay fairly tight around here. We do have one event today, we've got two economic data releases today, one of which is, I would say, fairly important, and that's the initial jobless claims. So that's coming actually in only half an hour. That's why I'm going to keep this fairly brief. But the initial jobless claims has been in focus over the last few months, and certainly over the last few weeks, as we saw an alarming rise in the middle of August. We saw an alarming rise of initial jobless claims getting back above 500,000. We got up to 504,000, which is the highest it's been since, I think it's November last year. So quite an alarming situation, given that the US economy has to have employment recovery if it wants its overall economy to sustain, its pace, going in the right direction. If we want to avoid a double dip, is what I'm trying to say, the US workforce has to recover. So if jobless claims are looking pretty bleak, that's not going to happen. What we've seen in the last couple of weeks, thankfully, is a drop back down in jobless claims, and last week it came in at 472,000. Bear in mind the average for this year is 465,000. Okay, I keep saying, I probably haven't said it for a month or so, but 440,000 has really been a great sort of support level for this figure this year. We haven't really got underneath that. We did once, but that was really due to the Independence Day bank holiday, so ignore that one. So 440,000 is really the best it's been this year. We want to see this trend back towards that figure, and eventually going into October and November we want to see it get back down towards 400,000 if we're going to see a labour market improvement, okay, and therefore sustained economic recovery. So jobless claims is at 130. We're looking for a small improvement on last week. The forecast is 470,000. Okay, last week it was 472,000. The average for the year 465. Bit of a, I guess, a psychological level. If we can get underneath that, it would be nice. But we'll have to wait and see. Obviously, we had a really good non-farm payrolls number last week. So can we get a bit more positive sentiment going on the labour market situation in America? We'll have to wait and see at 130. Also at 130, we've got the US international trade balance. We're looking for that to actually decrease. The forecast is for minus 47 billion. Last month it was almost minus 50 billion. The reason for this, and this is for the month of July, this is figures for the month of July, the reason why forecasters are saying it should shrink by 3 billion is the fact that the US the US recovery has stumbled through the summer, and there's been concern about it, and therefore the level of importing should have decreased. Okay, the appetite for the US consumer to buy goods abroad should have decreased. That's why we think the international trade balance will also decrease. Okay, that's probably not as important though, guys, as the jobless claims. So both those figures are at 130. The other data release of the day will be the delayed oil inventories number. That's going to be at 4 o'clock. It's normally on Wednesday at 3:30, but because of the bank holiday it gets pushed back a day. So 4 o'clock, guys, we've got oil inventories. There's still a little bit of concern about the increase in supply of oil in the US. We'll have to wait and see if that impacts. If you see my oil chart here on the bottom left, you can see I've got over the last sort of couple of weeks, and really since last week's rally, more of a sort of risk asset rally, really, we've been in a kind of range really between $73 and $75.50. So can the inventory numbers get us up above that range, or possibly more probable would be increased supply, maybe pointing us back towards the bottom side of that range? We'll have to wait and see. Those figures are going to be at 4 o'clock. But otherwise, generally speaking, as Andrea has put in his report this morning, keep trade volumes fairly low, guys, I would say. I don't think it's going to be a particularly active session. I think we've got to wait till next week until we get into the thick of things following the summer lull. Okay, so I think it may well be fairly quiet. Having seen the European debt crisis concerns just get off the front pages again yesterday and today, we think the removal of that fear should put us back on the kind of front foot that we were on last week. We see a drift higher for risk assets. We think equities may well, assuming we can get a reasonable jobless number, we think we can get up and test 1107 and maybe rise above that. If I just go to a longer term chart here, actually I want to go to a daily chart for the equities just to finish up, because we all know what's been happening in the summer of sort of turmoil, and really we've been in a bit of a range. Sorry, I don't have any levels on this chart for some reason. Our range through the summer, I would say, is largely speaking been between those two lines I've just drawn on. We did have a dip below that in early July, but ultimately I think we can drift up and test the top of our range, and I think whether we get above it or not will very much depend on the economic data releases next week, which are very important, starting with retail sales on Tuesday. If we get a good week of data next week, guys, I think we can move above the range we've been in all summer, and then things might get a little bit more interesting. But that's getting ahead of myself. First of all, we've got to negotiate today. Should be fairly quiet, I would say, but main focus on the 130 jobs number. Okay, guys, have a good session. Thanks a lot.